Okay, and we are live.
All right, thank you guys for tuning in. I'm so glad you're here. We have an amazing webinar for you today. I'm excited to be here with these amazing women that you see here on the screen. We are the Platinum Experience Group, me and Vanessa James, with the lovely Queens of Credit, Dr. Ashanti, Odom, and Shenequwa 𝕍𝕗, and of course the lending guru, Cenaca Cyprian with On-Time Lending. So we are really excited. We're gonna hold on for a few more minutes to get some more people to watch in on us. But if you have questions, make sure you put them in the group chat so that we can answer those as we go along. And I see they starting to come in, so we're excited.
Yes, you guys are in for a real treat today with the amazing panelists that we have lined up. I'm Vanessa James. I'm part of the Platinum Experience Group, and we're going to go ahead and get started in the essence of time because we have a lot of material to cover with you today. Let me go ahead and share my screen. Okay, so we're going over the virtual home buyer happy hour. And it's basically for us to have an opportunity to have a discussion about home ownership, right? But we know it's about more than home ownership. There are so many components to that. First of all, starting with your credit. So, we have our gurus on here today so they can share some information with that about you. Some information about that with you, and also to be able to go over what that process looks like. And that's where we come in as a real estate team. And last but not least, nothing happens without the lender. Absolutely nothing. So we definitely want for her to be able to go over what that loan process looks like for you. Also to be able to give you some insight into some exclusive loan programs that she has available for first-time home buyers. Also to be able to put you in position for home ownership so you can go ahead and take the next steps. So just to give you a quick intro for our team, I'll be brief here because we have a lot of content to cover. The Platinum Experience Group, we're a top producing real estate team that's powered by Keller Williams Professionals. It's one of the largest real estate firms internationally. So we're not just here. We are your international agents. Anywhere you want to move, we can help you with that. We have over 13 years of experience. We're also certified Credit Smart instructor, and that's provided by Freddie Mac. And we're able to go over and provide specific classes for you that teach about home ownership, fair credit reporting, being able to manage your credit, budgeting, and all of those things. We have over 8 specialized real estate designations, and more specifically in terms of some of those certifications, we're certified in working with veterans, with buyers, with sellers, with luxury clients, and last but not least, certified negotiation experts. So, our mantra here is really just to deliver service with integrity, to really be able to leverage our experience so that we can produce the results that you want as a client, because we're not looking at one transaction. We want our clients to be clients for life, and they have been. So we want to, you can just come in and join the family that we already have established. So I want to go ahead and hand it over to our Queens of Credit so that they can introduce themselves to you today.
What's going on, everybody? Listen, we are so excited that you all are tuned in. 2020 is all about clear vision and definitely getting in a place of where you can have possession of ownership. I'm Dr. Ashanti Odom, and I am a board certified credit consultant, global humanitarian. I've been featured on Fox, CBS, and NBC. I will say that my passion truly is helping individuals like you get to the next level. And my business partner, the other queen of queens of credit. Go ahead, Shenequwa.
Hi, guys. My name is Shenequwa, and I'm so excited to be on here today to share a wealth of information to help you get the dream home that you're looking to purchase. We help educate as well as we want to help generate you the information that you need to create wealth. So this is going to be a wealth of information, and I'm excited to get started with you today.
Absolutely. So let's just go ahead and jump right in and start talking about credit, the impact of credit, the importance of credit, and how you'll be able to leverage credit to move into your brand new home. Are y'all ready for that?
Yeah.
Awesome. So I want to go ahead and break down exactly how credit works. There are 5 components when it comes to getting your sorry, I'm sorry. Was that? No, listen. I am Cenaca.
You're excited. Look,
Yes.
just ready to dive in. Look, they say you don't have to get ready if you're already ready. You are ready. So we're going to go ahead and have our mortgage broker to introduce herself, and then we'll go into the real estate portion, just what that transaction looks like. We'll go into credit, and then we'll finish it with the mortgage broker, and that's really where you start in regards to this process. So we're going to go ahead and have Ms. Cenaca to introduce herself to us.
All right. Hello, everyone. I am Cenaca Cyprian. I'm a branch manager / broker of On Time Lending Houston, which is the very first branch in the Houston area. My corporate office is out of Dallas. So I have a lot of programs that I'm so excited to share with you all and help many of you become homeowners. Like Vanessa said earlier, it starts with the lender. Basically, you have to know where you stand and where you going. Sometimes I tell people I'm like your GPS, right? When you get in a car and you're going to take a trip or you go somewhere you don't know, the first thing you do, you have to figure out, let me put the address in, let me see where I'm going, right? That's who I am. I'm that person. I'm going to look at your credit, look over your income, check your assets, talk about the whole credit profile, what's in the credit report, and I can give you a game plan and tell you exactly what you need to do, exactly how we're going to get there, so you can become a homeowner.
Absolutely. Thank you so much. We look forward to hearing from your segment as well. Tasha's going to go over the agenda.
Yes, we're excited. Let's talk about this agenda. I know this is going to be amazing. I'm just going to touch on exactly what you're going to hear today. We're going to touch on why home ownership matters, because that's a huge important to know. We're going to go over the process. I'll walk you through that journey. Then we'll go over the key factors to consider. And of course, we're going to talk about credit and budgeting, the 101, your tips and resources. We're going to talk about getting approved for a loan, what required documents you're going to need. We'll talk about down payment assistance programs, common lending issues. You'll have the ability to ask questions and get those answers live, or you can also schedule those one-on-one consultations with any one of these amazing panelists here today. So we'll definitely jump right into it because we have a lot to share, and I want to make sure that you get all of this knowledge we're about to bless you guys with.
Thank you so much, Tasha. That is a jam-packed agenda. So again, as she mentioned, if you have questions, feel free to submit them on the Platinum Experience Group page. We will be answering questions live, and we'll also have Q&A at the end. So if you have any questions, please feel free to ask them. So the first thing we want to talk about is why home ownership matters. One of the biggest things is, it's a sense of pride and accomplishment, right? Everyone wants a piece of the American dream, and this allows you to put down roots in your community. So from a social standpoint, you're raising your kids there, you become a part of that community, the school system. I mean, it really allows you to establish yourself overall. Oftentimes it's less than expensive than renting. So, if you're going to pay rent anyway, why not own and be able to purchase and actually use that as an appreciating asset to be able to build wealth? Speaking of building wealth, there are mortgage tax deduction benefits from being a homeowner. So you're able to reduce some of your tax liability by having some of those write-offs. So now you have more disposable income as a result of being a homeowner on an asset that's appreciating. So that's going to allow you to build wealth over time. And then the capital gains exclusion. Because if it's your primary residence, you have an opportunity to be able to sell that property. And let's say you've owned that property for at least 2 out of the last 5 years and claimed it as your homestead. You're able to receive all of the proceeds, whatever profit you have from that property, up to $250,000 tax-free if you're single, up to $500,000 if you're married. So if you just make the right move to the right area where the home is appreciating, you've actually just made a very sound investment into your future. And last but not least, if that doesn't encourage you enough to be a homeowner, average net worth of a homeowner is $232,000. The average net worth of a renter is $5,200, and that's based on the Federal Reserve Survey of Consumer Finance, which was conducted back in 2018. So it definitely pays for you to be a homeowner as opposed to continuing to rent. So Tasha's going to share the real estate process with you.
Yes, let's talk about the fun part, right? So that's where everybody wants to know. How do I get started? What does this look like? What does that process entail? The really one benefits of definitely using a realtor is having that trusted guide to go through this process with you, because it can be challenging, overwhelming, especially from our first-time home buyers. You don't know what you don't know till you get involved with it. So we're truly here to work for you and with you through this entire process. We're not part-time realtors. We do this full-time for a living because we understand this is a huge financial investment for you, and we want to make sure you're educated along the way. So the first step is meeting with a realtor, meeting with the right people who's going to be a great fit for you, that you can trust to represent you throughout the transaction. The second one is getting pre-approved with the lender, matching you with the great lender who has the best programs that's going to best fit you and your family. Once she runs through your credit and understand where you are, she's going to give you a pre-approval letter. Like she said, that's a GPS, that's a navigation on where we're going, what your price point is before we start looking for the home, because we need to know where we're going and how much before we find that right home for you. So you get your pre-approval letter. Woohoo! Congratulations, that's the first step. The second step is now we're going to start finding your home search. Now, we do have a lot of activity right now in the market because it's hot right now. So there's a lot of listings going on right now. So it's a really, really great time to buy. We can start sending you listings to your email daily, ASAP, instantly. As soon as they hit the market, you have access to those homes. You find a home that you love and say, hey, Tasha, Vanessa, this is it. I want to go see it. We pull up a list of homes for you. We schedule the tour and we start showing you the homes. You say, okay, this is the house. I love it. I want it. Let's go. The next step is we got to make an offer because you love it and so does someone else and so does someone else. So we want to make sure that we work for you and putting in a competitive offer so you can get that house. Specifically, we'll do is set up a contract. We'll review the terms with you. We'll negotiate those terms with you. Make sure you're comfortable with it. You sign it, then we move forward. They accepted your offer. We're ready to go. Woohoo! Congratulations. Second step. We got a next step. Going under contract. That's when we make sure that the title company comes in. They're going to review and make sure they can transfer title from one owner to the next owner. Make sure there's no back taxes. There's no past liens on the property. Make sure they can clear the title. And they're kind of being the middle management and holding the funds. The lender's going to be involved as well. The underwriting team is going to be reviewing your statements, reviewing your documents, reviewing your credit again to make sure that they can fully process that loan for you at the end, because you're pre-approved and then you have to be final approved. So it's very important during that time frame that we don't do anything to the credit. We don't do anything to adjust your chances of getting finally approved at the end, because they will run it again at the end. Once we go through that, we'll get your final closing. Usually, typically, it's about 30 days, 45 days, depending on the type of loan that you have. But everything checks out. Everything looks good. We schedule to go to the title office. You sign your documents, and you get keys to your new house. Now, I know that sounds easy to throw, but trust me, it's very simple, but we can definitely, like I said, make sure that we walk you through each step of the way.
Absolutely, absolutely. So as you can see, there's so many moving parts, and this is one of the key reasons why you want to hire a realtor to help you navigate this entire process. I like to say that it might be your first rodeo, or maybe your second, but it's not ours. So we can definitely walk you through this process and, you know, really help streamline that for you. Now, when you first start deciding you want to purchase a home, that first inclination might be to go to a website or to go to the model home, see which home gives you the warm and fuzzies. But it's a little bit more than that, right? Not just the warm and fuzzies. There's some key considerations, things that you want to keep in mind when you're looking to purchase a home. First of all, do you want it to be new construction versus existing construction? And I have clients ask me that all the time. The reality is it's a personal preference. Obviously, new construction comes with some perks. You're the first homeowner for that particular home. You get to customize some of the options, take advantage of some of the modern floor plans, and maybe even upgrades with that home. A lot of the times the builders offer incentives, so that'll help reduce the amount of money that you have to bring to closing. So a new home with some, bringing in less money, that could be a good incentive for you. Moving to a different area. We talked about establishing yourself in the community and putting down roots. Maybe you want to move to another side of town. Maybe you want to move closer to your support system. So that could work out. Equally important, I've seen existing homes that are just as nice, that are kind of like when you buy a car and it's certified pre-owned. I've seen homes that, still are just as nice, but, maybe you're not the first owner. So it really depends on how that home lines up with what you're looking for. Location is important in terms of the community that you're moving into. Just from an affordability standpoint, how much can you afford? And one thing I never want our clients to do is live at the top of their budget, because things happen, right? Look at COVID-19. No one saw that coming. No one. Well, I guess we did, but we didn't take it as serious as we should have. But it happened. So from an affordability standpoint, making sure that if something should happen, you can still maintain your mortgage on the home because you're not living at the top of your budget. Or if something happened and you're a 2-income household, something happened to one of the incomes, can you still sustain that mortgage? Also look at the schools. What are the schools that your kids will be attending? One of the websites we recommend is greatschools.org. You can go there, plug in the address, and it will give you all of the information about that particular school district. Also the tax rate, that's important. The tax rate is going to influence your monthly payment because that's going to affect your property taxes for that particular area. Also the HOA dues, because ultimately what we're looking at is the total cost of ownership. So I know you may look at that home and it may give you the warm and fuzzies, but we need a little bit more than that. We're about to make a long-term commitment, and we need to make sure we do this the right way. And that's the importance of having us with you, because we see blind sites that you're not even aware of. And we can make you aware of those so that you can make an educated decision about one of the most expensive purchases that you'll probably ever make. So Tasha's going to share why hire a realtor.
Yes, it's so important, especially in our communities. Home ownership is a huge accomplishment, and I'm just excited to be able to be on this platform to be even discussing, because this is huge. So let's talk about why you should hire a realtor. Fiduciary. Our duty by law is to work and represent your best interests by law. That is our fiduciary duty, to make sure that your interests are protected. Definitely want to make sure, just think about, we're your assist. We're there to truly assist you. We're not there to push you to any direction that you want. We're truly here to assist your dreams and your goals. Contract negotiation. Just because they're listing a house for a price doesn't mean you have to pay for that price. We can discuss negotiations that best fit you and your needs. We're going to consider if you need closing costs, if we need to negotiate some money on the back end for you for your closing costs. Whatever it is that you need, we're going to be there to help assist you. Market knowledge and experience, understanding which areas have high tax rate, have high HOAs, because that contributes to your total cost of ownership. Helping you evaluate the home purchase. Again, not there to influence you, but just to be able to provide knowledge to you. Did it flood? Is there any issues with the house? Is there any major repairs that you need to be worried about? Just getting all that data for you, running comps for you, making sure that the price matches what you should be offering, seeing what the properties that are comparable in the past 6 months. Does it make sense? And let's talk about the numbers. Having that great relationship with your lender to see where are they, where do they need to be in their budget, helping you find the right home that's going to best fit everything. Professional recommendations and lender networks. If you need a home inspector, home warranty, home insurance, anything that you need, we're like a concierge service, providing you with suggestions that are available to you. So you don't have to have everything or know everyone, We'll definitely be able to connect the dots for you. Again, making sure you understand every step. Okay, we're here. What's next? What do I need to do? Who do I need to know? How much is that going to cost me? What are my out-of-pocket expenses? What do I need up front? What do I need at the end? Truly just having that person you can call and just say, okay, what about this now? So just really giving you an in-depth insight on this entire process and transaction. Coordinating it, the same thing, educating, guiding you, and navigating you. I just really can't, whether it's resale, new construction, building, anything that you want to do, we really truly can help assist you. We do not get paid from you. You do not pay us anything. We work truly for you. So it's just really important just to have someone who's going to go to bat for you and making sure that your dreams are real.
Awesome. So just going over some quick stats here right now. 89% of buyers actually use a realtor to buy a home. So, you know, when you think about that in terms of majority, you'll see the value of realtors. And there's no charge for you actually using a realtor when you're buying a home. So why wouldn't you have someone who has the knowledge, who has the experience, who can negotiate on your behalf and really be an advocate or fiduciary for you, help you with this expensive purchase? Also, 52% of buyers, their primary reason for hiring an agent is to help them find the right home. And I think that's the contrast between those warm and fuzzies and this home, is it going to work long term? Does it fit my budget, what I'm looking for with my kids, you know, what I'm anticipating in the next 5 to 10 years? That's the average time frame that someone will live in a home before they sell it. So we're looking at the long term and how this home is going to work to help you. And then 5% of buyers purchase a home directly through the builder or builder's agent. So that's a very small percentage of buyers. And just so you know, in terms of agency, when you go to the builder, the salesperson that's there at the new construction home site, they represent the builder, they represent the seller. You need someone who represents you in that transaction. That's where the realtor comes into play. And you can see 5% of buyers are going in there, you know, and that's not to say you couldn't buy the home without a realtor. Don't get me wrong, you absolutely could. But I don't know about you. I want to get the best deal, the best home, the best terms, everything across the board. So I need someone who's going to go in there and really just be, we're not lawyers, but we'll say you're an advocate in terms of helping you get the best deal when you're looking to purchase the home. And Tasha's going to close us out here with some common buyer mistakes.
Okay, so yeah, these are the do nots. Not a agent, because truly it's only a benefit for you to hire a real estate agent, because that we can just help you understanding the contracts, understanding the terms, helping negotiate for you, finding the right place, the right home at the right time within the right budget. So definitely not hiring a real estate agent is a common mistake. Not keeping an eye on your credit score, that's huge, because even if you get there in the beginning and then something happens throughout the transaction, not keeping an eye on that, because that could affect you at the end, and you don't want to put all your time and energy and effort into a home to find out that the deal falls apart at the end. So keeping your credit score and keeping an eye on that is very important. Looking for homes before getting pre-approved. We say that because we don't want you to go into a home and fall in love with the home and it's something out of reach and then you get deflated. So we definitely want to make sure we get pre-approved first, so we know exactly what we want, what we can do, and we can act on it. There's nothing like buying a house and then you can't get it, because it's moving so fast. The market, trust me, the house you see today is not gonna, if it's a good house, considering it's not going to be there next month, it's not going to be there next week. So we want to make sure that when we are ready to go look at a house, that you're able to make a move on it right away. Not shopping around for a mortgage, because those are hard inquiries on your credit. That's going to continue to hurt. You want to make sure that we match you with the right lender to get you pre-qualified before you put in your loan application. Like Ms. Cenaca, who has some great programs for you. So we definitely do our due diligence to check to see, is it the first time home buyer education programs? Are you looking for down payment assistance programs? Are you a veteran? Are you looking for those types? So we'll definitely make sure that you're not shopping around. We help you in getting you matched together. Buying a house more than you can afford. There's nothing like getting a house and then not able to keep it. We definitely don't want that to happen. We don't want you to max out of your budget. Obviously, we want to make sure that you save some money as well. It's the full total cost of ownership, and we want to make sure that not only are you getting a price point, but considering all of the key factors. as well. And skipping the home inspection is huge because that's not a requirement. It's optional, but it's so important, especially because even if it's new construction, even though it looks good, you don't know what's behind those walls. You don't know just with the storms. You don't just make sure, you want to make sure it's a huge investment for you. And we don't want to make sure that you're buying a house and then have to spend a lot of more money fixing things like the roofing, foundation, plumbing, just some of those major appliances that can break down, that we want to make sure that you keep in mind as well when shopping for a house. So definitely some mistakes, but like I said, you keep a good realtor with you, like the Platinum Experience Group. We'll make sure that you stay right on track.
All right, thank you so much. We have a comment here from Shenequwa that says, thanks for all the information. We appreciate it. Thank you. We know you have other things you could be doing on Saturday, but you decided to be here with us. So that tells us that you're serious about becoming a homeowner. But one thing I'm serious about is credit. And the next panelist coming up, I'm about to start taking notes, you guys, because we have the queen of credit. I'm about to step back.
Listen, y'all, okay, so now I know it's time to go. So listen, we're so excited. I don't think I understood how important credit was until I got older. Simply because you don't need credit until you typically need credit. And then you realize how powerful credit is. So I know we already did our bios and we're talking about it. So Shenequwa is going to lead us right into understanding about credit.
Yes, let's talk about it, guys. We have, we need credit now. You're getting ready to purchase a home and you want to know, well, what does my credit have to do with anything? It has a lot to do with purchasing a home. So it helps you get lower interest rate. We want you to get the best interest rate because what? You want a lower payment overall when you are getting ready to purchase a home. You don't want to purchase a home and your house note is way out of what you want to be paying monthly. Also, it gives you purchasing power. Right? You want to tell the real estate agents, Vanessa and Tasha, okay, I want this, this, and this. And they was like, well, according to your pre-approval letter, you can get this, this, and this. So it gives you purchasing power. And that is so important because you don't want to fall in love with a home and you're not able to get it, right? So having great credit or excellent credit gives you purchasing power. It's also opportunity-wise when it comes to getting a job. Some jobs look at your credit. Some jobs, like if you're working, especially in the banking system, working at a bank, they look at your credit because it shows you your character. Now, we all know that we've messed up. We all know that we've done things because we were not taught about credit, right? But as a lender looking at your credit, they absolutely look at it and they look at your character reflecting your credit, right? And that, we know that we make mistakes, but they don't look at that as that. And then your down payment. When you're getting ready to purchase your home, you want your down payment to be as low as possible, right? You don't want to have to come to the table with much, but with your credit being excellent, that gives you the power to have a lower down payment. Also, in real estate, you can go into investment options when you have excellent credit. You can begin to purchase property, and you can start making money leveraging your credit. And also, if you already have your dream home, you can refinancing your home because maybe when you purchased your home in the beginning, it was not the best, your credit wasn't as high as you wanted it. But now that you have excellent credit, you can go ahead and refinance that. Also, lower insurance premium. When you get a home, you have to have insurance, right? So you want to make sure that credit score is where you need it to be. Also, auto insurance. You guys, your credit has 700 and above credit score. Go back and tell your insurance company, auto insurance company, hey, I want you to rerun my credit because I believe that my credit score can help get me a lower premium. So now Ashanti is going to talk to you about how to manage your credit.
So let's go ahead and break the credit score down, okay? So there are 5 elements when it comes to understanding your credit score. And so this is so important because Shenequwa made a very interesting statement. They didn't teach us about this in school. They didn't teach us about credit, financing, budgeting. You know, they taught us about a lot of different stuff, but we missed the mark on credit. And so most people don't realize if you make one late payment, right? You can make one late payment and you can watch your score. Depending on where you are, your score can drop anywhere from 40 points all the way up to 120 points. Why is that, right? The higher your score is, the greater the impact. So that's responsible for 35% of your FICO score. So when you think about, you know, is it worth making a late payment on a credit card or a card note? Absolutely not. Because those late payments will affect you for the next 2 years. Now, some of you might be saying, Ashanti, I already have some late payments. What can I do about that? We can actually delete late payments from your credit report. And guess what it's going to do? It's going to boost your score 35%. So when you are in the process, and maybe like right now, we know it's a pandemic going on. And of course, there are several different options. And you want to make sure if you're calling the company to do a forbearance or to hold off on a payment or move a payment to the end, that they are honoring that and that it's not going to report as a late payment. Because I'm telling you now, if that late payment hits your account the very next month, it's going to drop your score 35%. Now, another huge element or factor in your credit is 30%. That is the amounts owed. So when you think about if you have a secured card or unsecured card or a line of credit, if you go over 30%, so just to make it more realistic, if your balance, not your balance, but if your limit is $1,000 and your balance is $500, you've already gone over 50%. What happens is that will affect your score up to 30%. And so realistically, most people are okay with maxing their cards out, which you shouldn't be, right? They're maxing their cards out and they're going over the utilization. And I'm telling you, it has such a massive negative impact on your credit. So if you have credit cards and lines of credit right now, and you're over the 30%, and I'm gonna be honest, like you really need to stay between 16% and right at 23%. That's like a safe zone. But if you stay in that zone, it actually will help your credit score go a lot higher. And so another question that we typically get is how soon will we see the increase? So if your statement date or your payment date is due, let's say today's the 13th. If it's due today and you made that payment 2 days prior, by the time they report it 2 to 3 days from now, it will impact your score. It'll go up this month. But if you make the payment or lessen the utilization after your payment date, it will not reflect until the following month when it's being reported. So it's so important that you understand those two factors. And I'm going to tell you why. If you make one late payment on a credit card that you maxed out, you just dropped your score 65%. Are y'all following me? 65%. That is a massive decrease. Now, new credit. So most people feel like it's okay to allow people to pull their credit. And in certain situations, it is. However, you do not want to be out there shopping for a car because those inquiries are harmful. Anytime you have hard inquiries, those are inquiries where the dealerships or the credit card companies, they're running your credit. When you're shopping for a mortgage, it's different guidelines. And I know Cenaca is going to cover that. But if you're out there shopping, like don't shop for a car when you know you're getting ready to buy a house. That's going to impact your score 10%. We can also delete that. Length of history is 15%. So if you have a credit card and you close that credit card just because you're not using it, which we'll go over that, you're going to drop your score 15%. So you want to make sure that even if you have a card that's barely in use, put like $5 on it because they will close those cards if they have absolutely no activity. And then finally, 10% is your credit mix. So that means installment and revolving, right? So fixed amounts and amounts that would fluctuate like credit cards and card notes. So you want to make sure that you have a good mix of exactly what's going on when it comes to your credit. And that is how your FICO score is broken up. So guys, please remember, when it comes to making a late payment or maxing out things, that you stay under that radar. Now, key considerations to consider: closing unused accounts. If it is like 5 to 7 years and you close it, you're going to lose all of that history. So you got to make sure that even if you don't need it, just keep a very small minimal balance. Trade lines, they're also a great way to boost your credit score, whether it's an unsecured trade line or a secured trade line. And I'll give you an example for many of you that are getting in a place, and you may already have excellent credit. Your kids that are coming out of school, and this is just a secret credit tip, your kids that are coming out of school, you can actually add them on as a user on your card. And when they graduate high school, going into college, and when it's time to purchase a home with Platinum, right? Platinum Group, okay? When it's time for them to purchase their home, their scores are already at 700, 800 because you did what they didn't do for us. Co-signing, do not under any circumstances, okay? Like, I wish I had captions to say it for me. Under any circumstances, co-sign on anything, because you can't guarantee that that person, whether it's a child, a loved one, a spouse, okay, you cannot co-sign. You just don't know if they're going to make their payments on time. And you just saw, if a late payment is made, it's going to drop at 35%. Revalidation of debt. What this means is most people say, well, in credit repair, if it's deleted, can it come back? And typically when that happens is three things have occurred. One of three things have occurred. One, the debt collector called you and you answered the phone and you re-verified that it was you. They just revalidated that debt and they're going to put it back on your credit the following month. The second thing is if your voicemail says your first and last name, okay, that's a way of revalidating your debt. You should change it to Office of Ashanti Odom, because they cannot use an employment. They can't use a place of employment to verify that debt. It physically has to be you. And the third thing is typically when you enter into a credit repair process, you'll start getting all kinds of love mail. Hey, we want to settle. We're going to give you 65% off. We just need you to mail this back. And when you mail it back, you validate it. Again, that is yours. Another way to help you with your credit is making sure that you increase the credit limits. So if your credit score is good and you think that you're going to have a problem with utilization, call the credit card company and ask for an increased limit, so that way you don't go over the 30%. Independent debt. This is something that a lot of married couples think that just because they're married, that they get to share the credit repair program. That's not true. When you were born, you had your own social security number, and so did your spouse. So it is a separate process. And just because we delete something off of your credit does not automatically delete it off of your spouse's credit. And lastly, debt consolidation. So debt consolidation, there are a lot of companies out there, but I will tell you this. It is a lot less inexpensive if you consolidate your own debt than you contacting a debt consolidation company, because they will end up charging you for the work that you could do yourself. Meaning that if the debt is $20,000 and it's 7 different credit cards and they're calling all 7 different companies, they're going to offer a settlement and then put their fee of debt consolidation on top. So you just want to make sure that you're saving as much money as possible.
Now, I just want to go over some credit myths that Ashanti kind of spoke on when she was talking about credit management. So 7 to 10 years waiting period, that is a myth. There is nothing in place that says that this credit is going to fall off between 7 to 10 years, right? Because they can resell it. One creditor can resell it, and it can be collection agencies that reverse it 10 years after, 12 years after you actually deal with the debt. But it's harmful, absolutely. Again, as Shanti was mentioning, it's 10%. Any new increase is 10% of your credit. So what you want to make sure you're not out shopping. Whatever credit monitoring services that you use, whether it's Identity IQ, Credit Karma, whatever, allow the lender wherever you're going to look at your scores before you actually get them ran. Um, Bankruptcy, we absolutely can delete them. There's no question about it. Paying off charge accounts, remove them. That is a myth. Just because you pay off a charge account does not mean that it's going to actually remove your debt. A lot of collection agencies will tell you, but by law, they do not have to remove it just because you paid it off. Are payment harmful? Absolutely. It's 35%, so it's going to drop your credit score 35% again. Will maxing out your cards harm your credit? Absolutely. We talked about utilization, where Shanti mentioned that you want to stay between the 16 and the 23%, because if you go over, lenders look at that you're not responsible with other people's money. So if a bank loans you money, or you have a credit card and you're not keeping that utilization rate under 23%, then they deem you as not being responsible for other people's money, as you're not responsible to use that amount of money that you borrowed. So we're going to close out. Ashanti, do you have anything else you want to say to our listeners?
Yes. So listen, we're all about gifts, prizes, and surprises. So,
Yes,
so we want to go ahead and make sure that for all of you that are tuned in, that we bless your life, because we know that having a brand new home is something that you deserve. So we're going to give you a free ebook that Shenequwa and I actually put together. It's 101 ways to get your score to a 750. And when Shenequwa gets on here and she talks to you guys about what kind of home you can get for that, I'm telling you. So what I want you to do is text READY to 832-559-2801. Text the word READY, READY, because you're ready, to 832-559-2801. And you're going to get that free ebook immediately of 101 ways to boost your credit score to 750.
Thank you, ladies, so much. You ladies are dropping the gems. Definitely go change your voicemail if you didn't catch that part. And it's here on live. So, go back, watch it again if you need to. Share it with a friend. Look, we have to help each other with this entire process. So I'm sure there's someone that can find value from this stream. So if you haven't already, please share it, like it. We want to impact as many lives as we can to help you get your credit, to help put you in a position of home ownership, and to help you start building wealth. But like we said before, none of this happens without the loan officer. Nothing. So we are going to go ahead and turn it over to the fabulous Miss Cenaca so that she can go over what she has to offer with you today.
All right. So I want to just thank you, ladies, for all the information you shared so far. Like Vanessa said, I am like that first step. Even before you get to the credit specialist, a lot of clients, a lot of first-time home buyers, they feel, oh, the first thing they do, oh, let me talk to a credit specialist first. Especially when they don't have the credit, or they feel like they need to work on the credit. But technically, you should speak to the lender first, because we know exactly what you need to do to get into their home. So I want to just dive into all of that. And my first area of specialties, of course, I cover a lot of different programs. So when you do that first appointment, when you come in to fill out an application, or either we're talking over the phone, doing a consultation, I'll try to figure out what is the best program for you, whether you qualify for a conventional loan, FHA loan, VA. There's so many different programs for so many different people.
Okay, thank you so much, Cenaca. We actually have a question. It was during the credit presentation, but it was regarding a lending question. It says using a VA loan, does your score have to be over 680?
No, it does not. But I will tell you, with everything that's going on with the coronavirus and COVID-19 overlays, some lenders have actually raised their requirements for their credit, minimum credit score requirements. So some banks, some brokers, some mortgage companies are requiring at least a 680 or 700 credit score. However, for my lenders, you only need a 600 credit score or higher to qualify for a VA loan.
Okay.
So can you say that again?
She said she's ready. Text this number. What's that number again? She's ready. Thank you so much.
Yeah. Oh, she want to text the ready for credit or the lender?
She's texting the ready so she can get the ebook to get her credit
Okay.
score.
Oh,
She gonna call you because she need a VA loan.
Awesome. So let's start about how to get started. So you got your approval criteria. So there's a couple of things I look over. One is your income, then your credit, debt to income ratio, and cash reserves. So let's talk about income. There are so many ways clients get paid. You have self-employed, you get 1099s, W-2s, you get paid hourly salary. Some people make commission, bonuses, overtime. So there's so many ways when we're looking at income. So, and most of the time, I have clients who are W-2. Only requirement I will need is your W-2s from the past 2 years. And then I look at your most recent pay stubs. Now, if you're self-employed, then I have to calculate at least 2 years of your self-employed income. And the way I will verify that your income is through your tax returns. So if you haven't filed tax returns, that's a must. So you have to file your tax returns if you're self-employed in order for me to calculate income. Now, let's just, for instance, if you are self-employed, you make the money, but you wrote off a lot of expenses because, that's what we do when we're self-employed. 1099, we got expenses. And of course, you don't want to pay the IRS, a lot of money in taxes. However, that can actually hurt you when you're trying to purchase a house, because when I'm looking at your tax returns at Schedule C, now it looks like you don't make enough money to actually qualify for the home. So one of two things can happen. I will tell you, okay, you have to file your taxes, you have to show your income, and then you will have to go back to your tax preparer, report enough income so you can qualify for a house. So that would be the first option. The second option, if you say, no, Seneca, that's not going to happen, I can't do that. So I do have other programs we call like non-QM programs where I can use your bank statements to qualify you for a house. So I will look at your bank statements over the past 12 to 24 months to calculate your income. Now, the third option would be a VOE program, where if you're 1099 and you work for an employer, I can get your employer to verify your income, where I don't have to look at tax returns, pay stubs, W-2s, or bank statements to calculate the income. It's only a third-party verification, almost like a stated income program, but you cannot state your own income. It has to come from a third party. So that's one of my favorite programs when I get clients who have like that, income that they're not actually reporting to the IRS. So the second thing, of course, is credit. So credit, we've heard a lot about credit from Ashanti. So credit is very, very important. I tell a lot of my clients, you definitely want to monitor your credit and keep an eye on your credit report. When you start the process of getting pre-approved, even before the process and even going throughout the process to you actually closing on the house, because you can come to me with a 700 credit score getting pre-approved, but let's say if you're getting a new home bill, that takes in for 6 months, Vanessa, Tasha.
Yeah.
So when that process, you really have to pay attention to your credit and don't go out and charge any items, you buy expensive cars or furniture bills or co-sign for anyone. Just try to pay all your bills on time, because you do not want the credit score to drop while you're in the process of purchasing a home or building a home, because we will pull your credit again before closing. And when you're building a home, you actually get your credit pull pre-approval. And then at the end, when you got to get pre-approved again, like 30 days before the house is complete. And then 3 times actually. And then right before closing, the underwriter's going to look at it again. So you have, like I tell all my clients, when you start the process, your credit becomes my credit, because I'm gonna make sure you don't do anything to mess my credit up.
I like the way that you said that, because I tell my clients, you're on probation. Everyone is watching you. They're monitoring everything you're doing. So do not make any strange moves. Look, don't make any unique purchases. So I like the fact that you mentioned that.
Yes, I even tell my clients, if you think you gotta make something, call me first. Be like, can I buy this? Is it okay? And I'm like, okay, yeah, you can do it. Because some people, you hear it all the time, like you don't buy a house. Don't buy a car first, buy the house first. So that is true to a certain extent. Some people may be able to purchase the car first, but it just depends on their income. It depends on their debt to income ratio, which we're about to talk about next. And also it depends on the credit. So debt to income ratio, how is that calculated? So the best way that I would tell my clients to calculate their debt to income ratio is to add up all of your debt that is reported to the credit bureaus. You only want to add up the minimum payments. So if your credit card, you have a credit card, is it secured or unsecured? If that credit limit is, let's say, $1,500, your balance is $1,000, your minimum payment is $15, then I got ahead of myself. You only take the $15 minimum payment, and you add up all your debt, including your future mortgage payment. And then you divide that by your gross monthly income. So that's the quickest way to to calculate your debt to income ratio, which is very, very important. You can have a 750 credit score, and I can't get you qualified at the time because your debt to income ratio could be too high. So it's important to talk to a loan specialist like myself, so we can see how can we lower your debt to income ratio. There's the things we can do. You may be able to pay down a credit card bill, or we can maybe exclude some debt that could be like an installment payment. If you have an installment payment with 10 or less payments left, that can be excluded from your debt to income ratio. Now, when you're getting the FHA loan, the debt to income ratio is a little bit higher. It goes up to like 56.99. But if you're getting a conventional loan, the debt to income ratio is 45 to like 50%, depending on the loan program. So cash reserves, that's another criteria when I'm looking at doing your pre-approval. And typically on a conventional loan program, we look for cash reserves. And it just depends on the credit score, it depends on the debt to income ratio, will determine how many months of cash reserves. If you're looking to purchase an investment property, we may have to show 6 months of cash reserves. So it really depends. When it comes to reserves, it depends. It's a lot of factors comes in place depending on credit score, income, and debt to income ratio. So the loan documents that I look for: 2 years tax returns if you are self-employed, or if you already own property, the rental properties. If you are W-2, I do not have to have your tax returns. W-2s for the past 2 years, 2 months of your most recent pay stubs, and also 2 months of your most recent bank statements.
Thank you. And we have a question, Seneca. I don't know if you want to take it now or address it when you go over the loan programs. But it's asking, do you work with down payment assistance programs like Texas Heroes?
Yes, I do. I have several down payment assistance programs, Texas Heroes, T-Shack. We have an in-house down payment assistance program, Shenequwa. So yes, I do work with several down payment assistance programs.
Okay, and we have one more that just popped up. Question about the DTI ratio. I was told when you apply for an FHA loan, they take 1% of your total loan amounts when you are on a repayment plan and pay less. Is this true? I'm assuming they're referring to student loans.
Yes, it is referring to student loans. So it is true. When you're getting an FHA loan, we do calculate 1% of the total loan amount of your student loans. Now, there is another way we can calculate it. If you call your student loan provider and ask for a fully amortized payment that is going to be a fixed payment for the lifetime of the loan, at least 25 years or more, then we can count a lower amount than that 1%.
I did not know that.
Yes.
I need that right now. Okay, thank you.
But it's usually still on a higher side. Let's say, for instance, you got $100,000 loan. That's 1%. That'll be $1,000 payment a month goes into your debt to income ratio. That same 100,000 loan, you get it on an amortized payment. The payment may be like $700. So, but that's a $300 difference that can make the client qualify.
Okay, great.
And those numbers, it could be a little bit less, a little bit more, but it's not like the payment drops from $1,000 to $100. It's not that big of a difference.
Right. It's not like an income-based repayment program where some people end up having not to make a payment at all, but it will be less than what you're paying. And so that's going to lower your debt to income ratio and increase the amount you qualify for. So it's still a benefit. Okay.
Yes, it is. So let's talk about loan affordability, PITI. So what that basically is, that it was make up your total mortgage payment. So you want to, when you're shopping online and you own Hard or Zillow or wherever you want to shop at, a lot of clients come to me and say, well, I did a mortgage calculator online and it told me I qualify for this. But what it didn't include was your property taxes and your homeowner's insurance. Only thing you see is probably that principal and interest. And you're thinking a $300,000 house you're gonna get in a $300,000 house for $1,200 a month. No. When you add the taxes and insurance, that $1,200 become $2,000, $2,500. So that PITI, your monthly mortgage payment, the P stands for principal. And of course, you see the I, that's your interest. And your interest rate can vary depending on your credit score from 2.5% interest rate. It can go all the way up to maybe 8% interest rate, just depending on the loan program. And then, of course, you have your annual real estate tax bill. You know, let me pause. I'm so sorry. My battery is blinking. I don't want it to cut off on me.
Wow, that is some great information. Like, I'm literally taking notes over here.
Yeah. And you know what? It does make sense because I've had clients that will say, well, this is what the internet is my mortgage payment. And I'm like, that's not right.
Right.
We do not do the bait and switch. We do not. It's just to generate a phone call. When we talk, that's why we said integrity, experience, and results. We are not trying to mislead you in any way. We want you to have full disclosure about what you're getting into and what it's going to cost you. So yeah, I'm so glad you're pointing out the entire PITI so that they understand what they're getting into when they're looking to purchase a home.
Right. And this PITI is really what give me an idea exactly how much house you qualify for. So when you say how much can I afford, I look at the whole mortgage payment, and that makes the principal, your interest. I gotta plug in your tax rate, so I really can't plug in that tax rate until you talk to Vanessa and you figure out where do you want to move, what part of town, and then she can kind of give you an idea where if you're going to Katy, the tax rate may be 3.3, but if you're going to Humble, the tax rate in Humble may be a little bit lower, like 2.8. I don't know, but certain parts of the city, you're going to pay a higher tax rate. So that's going to be very important when you're getting pre-approved, when you're out shopping for a home. And then you have your homeowner's insurance. That's going to be in part of your mortgage payment as well. And then you have your HOA. That's not a part of your mortgage payment, but it is an annual payment. However, we still calculate that payment into your debt to income ratio. So if you're moving to a community where the HOA is $1,200 a year versus $200, $300 a year, that can actually, affect the amount of house whether you qualify for that particular house or not. So let's talk about the loan option program. If you get pre-approved for FHA, the minimum down payment for FHA loan is 3.5%. Actually, credit score for FHA for my lenders is a 580. It goes down to 580, and I have some that will actually, it go down to about 550 if you put 10% down. But for those that are looking to purchase a house with 550, I try to coach them and send them to credit repair because it's really hard to get approved with a 550 credit score. So if your credit score is at least a 580 or higher, you can get approved with the FHA loan. The debt to income ratio, you have 55%, but sometimes depending on DU, which is a desktop underwriting system that we use to get you pre-approved, it can go up a little bit higher to about 56.99. And then for conventional loans, you can do 3% to 5% down, credit score 620 or higher. The DTI is a little bit less, 45 to 50%, depending on the loan program. Now, as far as the credit score, I would say conventional loans is a little bit harder to get pre-approved for. It requires a higher credit score. If the credit score is on the low side of 620, that means you have to have substantial income and your DTI has to be like less than 45% to get a lower pre-approval with conventional. Now, if your credit score is 680 or higher, then that 45 to 50% DTI, I could probably get you pre-approved. VA, 0 down. And if you are a veteran, I always ask, are you disabled? Because if you're disabled, depending on the percentage, you will save on your taxes. I have a lot of veterans. Matter of fact, if you're 100% disabled, that's 0 taxes. You don't have to pay any taxes. So that's good to know when you're a disabled veteran. And then, of course, the credit score for VA for my lenders is only a 600. And DTI is 41%. That is the minimum. I actually got a client approved last week with a 60% DTI on VA loan.
Wow.
Yeah, so the DTI actually goes up depending on their residual income.
Okay.
And then USDA, that's a 0 down. And USDA is like if you're looking to purchase a home in a rural area, the credit score is 640 and DTI is 41%.
So, Seneca, if you could touch on USDA just a little bit, because sometimes people have maybe a misconception of what a USDA area is. It's oftentimes areas where you might want to stay throughout the Houston area, like Fresno or Tomball or areas like that, Manville. So there's some very attractive and growing. I told you to answer, and then I'm answering questions.
Wow, you did good.
I just wanted to
said, it's just USDA is not just, some people think, oh, it's in a small town, in a country area, there's nothing around, but that's not necessarily true. You can go to Manville, Rocheron, Tomball. It's just the area that's like outside of the city limits, but you can find nice home in a USDA area, and also new constructions that is not very expensive in the rural areas as well.
We have a question. So do these programs apply to first-time home buyers as well?
Yes. Every loan program fits a first-time home buyer. An FHA loan, conventional loan, VA, or USDA. It just depends on your credit score, your debt-to-income ratio, your profile history will determine which loan program is the best. And I tell all my clients, just because, let's say, your cousin or your coworker, they say, oh, the FHA loan is best or conventional loan is best. No loan program is better than the other loan program. It just depends on what program fits you the best.
Thank you for sharing that. I'm glad you highlighted that, because when you think about the loan process, it's complex. There are so many different variables. In everyone's situation, it's not the same. So like you said, while it might be good for someone to go FHA, someone else may be in a better situation to go conventional. So please consult the professionals. We are here to guide you throughout this process and help you so that, again, we can get you in the best home with the best loan under the best terms. We want to get you the best of everything.
Right, yes. And mortgage insurance. So mortgage insurance is required when you put down less than 20% on a home. So when you're looking at the conventional loans earlier, like we talked about, the down payment is anywhere from, the minimum down payment is 3%. If you want to avoid the private mortgage insurance, which is what we call PMI, you have to put 20% down on a conventional loan. Now, a lot of people think that they have to have 20% to get into a house. As you see, you don't need 20%. The only reason why you have to put 20% down is if you wanted to avoid the PMI. So what is PMI? You're basically paying for this private mortgage insurance that protects the lender. It's no benefit to you whatsoever. It's really, you're just giving away maybe $100 to $200 a month, depending on the size of the loan. Now, if you're not able to put the 20% down on a conventional loan, typically once you reach 80%, which is 20% of equity in your home, that PMI automatically go away. Now, you can call the mortgage company, call your lender once you reach 78% LTV, and they can remove it as well. But once it reaches 80, it automatically go away. So that's good to know that you can do it before it reaches 80. Now, the MIP is mortgage insurance premium, is what is you pay when you get an FHA loan. Now, the FHA MIP, there's no way to avoid it. You actually have to pay the MIP over the lifetime of the FHA loan. The only way that you can avoid a FHA MIP is to refinance into a conventional loan program. So, but either way, the money is backed by it's actually protecting the lender if something that happens to the house, you foreclose. So that money will be going to protect the lender.
Cenaca, can you just touch on, because you spoke about refinancing, and I know rates are historically low right now. So maybe for someone who is a homeowner and they might be considering refinancing, can you kind of give them an idea of what interest rates are looking like right now?
Yes. So like Vanessa said, rates are at an all-time low. If you have a conventional loan and you wanted to refinance, I would say your credit score. I have a program now, actually. If you have a conventional loan, you're looking to refinance, the rates are anywhere from 2.5 to 3.25, and your credit score has to be at least a 640 or higher.
Wow.
So that is a great program that we just rolled out actually a couple of months ago. So it really will help people who are in a conventional loan, because most of the time the conventional interest rates are a tad bit higher than FHA rates, because FHA programs are typically for the first time home buyers. So the government set the rates. So with FHA loans, so it's about a quarter to probably a half point less. But with this particular program that just launched 2 months ago, is they're being very aggressive towards conventional loans. So if you have a conventional loan, you can get a interest rate as low as 2.5%. As far as FHA loans, same thing. The rates are starting at 2.5% on an FHA loan, long as your credit score is 640 or higher.
Wow. And that's amazing. I haven't seen rates like this. I've been in the business about 13 years now. I have not seen rates this low. And we're just saying 640. At the Queens of Credit, talking about getting you to 750.
Right?
I mean,
So 750, you definitely getting a 2.5. So
and we're not talking about a new house too. So yeah, those are some good options. So I always get this question in terms of savings. You know, first time home buyers are like, how much money should I have saved? So can you just share a little bit about that with us?
So that's a good question, and I get the question a lot, and it's really hard to answer that question for my buyers because everybody's situation is different. Everyone is buying a different amount of house, but just to have an idea, the I would say start between, like you say, 6 to 8% of the total sales price. So if your house is, let's say the average house is in Houston is what, 200, what is you 200,000. So 6% of that, what's that? My math is wrong. 12,000.
12,000.
Yeah, so $12,000 would be a good amount to have saved up. Now, do you have to use the whole $12,000? No, you do not. The number can be much lower, just depending if you're receiving any down payment assistance, or if Vanessa and Tasha negotiate where the seller is paying your closing costs. So that number can definitely be lower. And if you tell me, come in, like you say, well, Seneca, I'm only able to save maybe $5,000 to $6,000, and then we can come up with a game plan. Well, if you're only able to save 5,000 to 6,000, then this is how much money you need in down payment assistance, and this is going to be how much money you're going to need in closing cost assistance to make the deal work. So again, the out-of-pocket expenses, you definitely have to have that saved up front. A lot of people think just because you're getting down payment assistance, which cover all of your down payment, and then your realtors, the platinum experience realtor, going to have the seller to pay all your closing costs, that you don't need any money. That is a myth. You need some money when you buying a house, and you got to have your out of pocket upfront expenses, like your earnest money. Your earnest money is typically 1% of the total cost of the house. So if you purchase a $300,000 home, you need $3,000 to put down for earnest money. Your inspection is going to be anywhere between $300 to $500, average $450. Then you're going to have to pay for an appraisal. Your appraisal is about $600 a month, and then you have your option fee, which can be what, $100 to $200. What other fees? And I'm not missing. I think that's pretty much it. So you're gonna need at least about $2,500 to $3,500 just for out of pocket expenses. Now, your earnest money and your appraisal fee, you do get credit. You get a credit at closing for that. So that's why you can hear a lot of people say, well, I got into my house, I purchased a house with zero down. It's because they received down payment assistance, or they probably was a veteran with zero down and the seller paid all the closing costs. So I would say that's a recommended statement, but it is not a one size fit all. It is definitely a case by case depending on the person.
Thank you for sharing that. We definitely want to make sure, that you guys are financially ready to move forward in the process. So part of that is knowing what that expense is going to be, and knowing it's not just a down payment and then you buy a home. No, you have closing costs. So you have to combine, right. So you have to have, the down payment, and that's based on the particular loan program that you sign up for. And then you have your closing costs as well. Yes, we can probably put you with a down payment assistance program if you qualify. We can also negotiate to get some of your closing costs paid, but you need to know the upfront costs before any credit, so you understand, what you're getting into when you're looking to purchase a home. And even before you get to the closing table, what those out-of-pocket expenses look like, so that you'll already have that money available. Because as soon as you go into contract, the timer is starting. There are strict dates on there, right, Tasha?
Right. And just to piggyback off of that, just to give you a timeline, as soon as we put that house under contract, you have 3 days to deliver that earnest money and option fee. So that $3,000 and the $150, which is your typical option fee, for your option period, which is when you have that window to get the house inspected to decide if you want to keep going or not. You have to provide that option fee. If you don't want the house, then you can terminate and get your earnest money back. But that option fee and that earnest money needs to be delivered within 3 days. So that's why it's good to know that up front. And like I said, having that conversation with Cenaca to see how much closing costs are going to be required up front, so we know what to go in when we put in the offer. So very good information to know up front. Absolutely.
We have a question here for someone. Congratulations, Miss Lulu. She says she has 10 years left before her home is paid off. Her interest rate is about 5%. Would it be worthwhile for her to refinance?
So I get that question a lot. Obviously, it really depends on your situation, and I say it's always worth refinancing because you're going to save. So if you save $100 a month, $75 a month, $200 a month, that's less money you will have to spend over the next 10 years of that loan. So yes, anytime you can cut your rate from 5% to 0.4% or 3%, that's 2 points that you could save. That yes, it's worth it. And you don't have to go into a 30-year mortgage. You don't need to do that. If you only have 10 years, you would just refinance into another 10-year term.
Okay. Seneca, question also. So you're able to run like an analysis for them to let them know what that would look like before they even start the process, right? What the monthly payment would look like, the amortization schedule, and everything.
Yes,
so
that's correct.
Okay, I'm really keen on that because I believe we have to be advocates and consultants for our clients. So we give them the information so they can make the educated decision. So I would strongly encourage Lulu to reach out to Cenaca. She offers free consultations so that she can put a scenario together for you to let you know what that looks like, and then you can make a decision as to whether that's a good option that you want to take advantage of, especially with these low rates.
Yes.
So I'm going to move on to the next slide here. Down payment assistance and special programs.
Yes, our favorite. So let's talk about down payment assistance and the programs. So like I said earlier, I have several down payment assistance programs, and typically the down payment assistance programs are for first-time home buyers. Some of the programs you do not have to be a first-time home buyer, so long as you have not owned a home within the last 3 years. So one of the programs, the TDHCA, it's a second lien. So a lot of people think, oh, down payment assistance. I'm gonna get my down payment for no down payment. Now it's not free. It's not a grant. So yes, you do have to pay it back. So it's not technically free. It is a soft second lien. So if you were to ever sell your home, pay off your home, or refinance, you will have to pay the down payment back. So it is income restricted. It goes up to 78% annually, depending on your county. So this program is a state program. It's not just for Harris County. It's for the state of Texas. So depending on your county that you live in will determine the annual income for that county. Now you have to be approved. The minimum credit score is 620 to use the program, and the down payment starts anywhere from 2% and it goes all the way up to 5%. So for instance, if you purchase in a $200,000 home, the 2% DPA will be $4,000 towards your down payment. That's 3.5%. Now, if you decide, okay, well, that's not enough, that's not going to cover my down payment, then you can go up to 5% or 4%. So if you get 5%, that your down payment assistance will be $10,000, and that 5% will cover all of your down payment, and the remaining will be applied towards your closing costs. So that's how a lot of clients are able to get it moving to purchase a house with zero down, because the down payment at 5% is covering all closing. 1.5 is going towards your closing costs, and then if you get closing cost assistance, that'll cover the rest. So you have zero money at the closing table to pay for. Now, 100% this is 100% finance. I'm sorry. I have another down payment assistance program that is 100% financing and is no income restriction. So that is phenomenal. So if you make $200,000 a year, you can qualify for down payment assistance. Now, I know you probably say, well, if you're making $200,000 a year, what do you need down payment assistance for? Well, let me tell you, some people just, they probably just started making the money and they just haven't saved the money yet. And then you have some people, they have the money saved up, but they don't want to go and use their money because, look at what's going around now with coronavirus. You want to leave as much money into your savings as possible because you just never know what may happen. So it's a lot of reason why people want to take advantage of the down payment assistance programs. And I talked about my conventional loan program earlier, where you can get the interest rates as low as 2.5%, starting, with your credit score at least 640 or higher. So there's tons of programs out there for everyone. Everyone may not qualify for down payment assistance, and if you don't, that's okay too, because I have programs where I can also give you credit for your closing costs. So I have, depending on your credit score, you can get a lender credit of anywhere from $1,000 to $2,000 to help with your closing costs. So schedule a 30-minute consultation, and I'll be happy to discuss your options and what loan programs work best for you.
Wow, that is amazing.
Those are some really strong programs. Trust me, guys, working with buyers, those are some amazing programs. You definitely want to give her a call if you're thinking about buying a home.
So, Seneca, regarding the 100% income, what was the minimum credit program?
I'm sorry,
Oh, I'm not sure what's happening. The minimum credit score for the 100% financing.
Yes. For FHA, the minimum credit score is 660, and for conventional, the minimum credit score is 680 or higher.
Okay, thank you. I'm not sure why we're echoing now. We made it through the whole presentation.
Basically, that must be great today.
So, Tasha, close us out on the helpful resources.
Yes, guys. So definitely we shared a lot of great tools with you. We will be emailing these out to you for those who have registered, but take a look at some of the links here below. Feel free to take a screenshot if you can. These are some links for credit. If you want to check and see what your free credit report is, you can go to annualcreditreport.com, download your free credit report from all 3 boroughs to see what's on there so you can know when you can be proactive in getting that debt cleared up. You can also look at myfico.com. That's the credit managing app that can tell you what your credit scores are on a monthly basis, so you can continue to manage it and keep an eye on it. We definitely trust those over Credit Karma because it's going to be more accurate in what the mortgage lenders use. They're going to look at your FICO score, not your bank score. So it's very important that you're not just looking at Credit Karma. You need to look at MyFICO. If you're interested in getting secured credit cards, if you're trying to build some credit and you need to build them, these are some great secured credit cards that you can look into and building your credit up. Regarding the down payment assistance programs that Ms. Cenaca was talking about, here's some links where you can get more information on all of those great special programs. Like I said, every one thing is not for everyone. So if you definitely find benefit and value from any of the programs she talked about, please definitely do your research, look into the links, and definitely give us a call. We can explain how we can get started for you. And then, of course, budgeting and finances, because it's so important. As we all know, this is a huge financial investment for you. We are building wealth for you and your family. And if you want to continue to manage your budget and finances, these are some great apps you can use and tools for your budgets, like the Mint app and the YNAB and Better Money Management and the DTI calculator, so you can understand what your DTI ratio is, because that is very important to know as well when applying for a mortgage.
If you would like this information, please feel free to message us and send it to the
Absolutely. Any questions, guys? Feel free, plug them in the chat box. I know we're going over an hour, but if you have any questions, please let us know. This is our contact page. Oh, sorry.
we pretty much been allowing you to out, so we don't have any additional questions that I've seen yet.
This is our contact us page, so if you're interested in getting started and you want to speak with an SNI, please feel free to call our number. You can also go to our website or reach out to us on our Facebook page. For the Queens of Credit, they are amazing. Definitely speak with them about any credit repair goals that you may have. This is the great number to contact them, and also their website. And they also have an amazing Facebook group page as well. And Ms. Cenaca does her phone number and contact, so we definitely need to get in contact with her on what your qualifications are going to look like for you to get that loan.
I don't know why I'm echoing over here.
Anything, so.
We'll get it.
Okay, well, thank you guys for tuning in. We are so excited you joined us. I hope you learned something. So even if you got to take away one nugget today, we're just so thankful that you're here. We are aimed to serve. We love what we do. You can tell we're very passionate about what we do. So we really are happy that you decided to register and join us. Again, if you found value, share it, send it, give us a call, contact us, schedule one-on-one consultations. We really, truly appreciate you and your time. We know it's a Saturday afternoon, and we just really feel this is so important for home ownership. So definitely share. Miss Queens, you guys are the same thing?
Oh, you see okay. Let's you go first.
Aww. Ms. Cenaca?
Oh, thank you for putting this together. It was a great, very informative, and I'm looking forward to working with all of you.
I just want to thank Tasha and Vanessa. Thank you guys for having me to helping other clients in the future. Let's get those houses.
I'm not sure why we start echoing at the end, but it was a great meeting, great content, great information. And if you missed something,
Thank you, ladies.
Thank you.
Have a good one. Thank you. Bye.